Hey there, do you have a variable rate mortgage where the payment adjusts with prime? In other words, an adjustable rate mortgage, aka ARM. With the recent increases to prime, you've seen your payments increase quite significantly, especially after the last prime increase of 1%. Now, you may have heard some mortgage brokers talk about static payment variables. Most of the big six banks offer these. The main difference is that your payment will stay static. The distribution of interest versus principal of your payment will change. So if prime goes up, more of your payment goes towards interest and less towards principal. Now, it's not so cut and dry. There are trigger rates and trigger points and a whole bunch of other things that I'm not going to go into here. If you have some questions, you can always reach out. But what some mortgage brokers are suggesting as a sound strategy is that if your stress levels are high, that your payments are going to be rising, i.e. you have one of those variables where the payment fluctuates with prime, that you should consider refinancing and going to a lender that offers the static payment. At first sight, this sounds like a good idea. Sure, you might be giving up a bit in terms of interest rate. You may have prime -1 right now with the current mortgage, and you might only be able to get prime minus 0.5 on your refinance. But what about the penalty and the legal fees to reset the mortgage with the new lender? And then, of course, there is the qualifying rate. Are you able to qualify right now, even? Is this really a sound strategy? Now, I had a client introduce me to his friend. He has a $900,000 mortgage, and he's worried about his payments going past a certain point. He was interested in this idea that he had heard on some podcast with some mortgage brokers. So we work through the numbers. Now, of course, he's got a variable rate where the payment adjusts, and this is his main concern. The way his lender calculates the penalty to break the mortgage, even though it is 3 months interest, it's based off of the current rates as opposed to the discounted rates and whatnot. In short, it's going to amount to about $9,000 per month. It was going to cost another $1,200 or so in legal fees, and not to mention the requalification process. I think they also need an appraisal on the property as well. So all in, to make the change to a lender with a static variable payment, it was going to cost about $10,600 or so. I think he had prime minus 0.95 as a discount on his current rate, current mortgage. Now, he got his mortgage in June of 2021. Now, I remember we were able to get clients prime minus 1.3 and rates like this back then, but that's another story. I know right now the best rate he'd get was about prime minus a half. So right off the bat, his payment was going to go from $4,153, which is what it was currently at the current rates, to about $4,382. And I think his maximum payment that he did not want to go over was $4,700. So that was what he was trying to avoid. That $4,700 per month translates to an interest rate of 4.8% or thereabouts. So if you have a discount of 1% below prime, that would mean that prime would be at about 5.8, another 1.2% from where it is now. So in this scenario, it would be about 1.05 from where it is right now. The extra fees to switch to a static payment variable, if you divide it into monthly payments, would be about $441 per month over 2 years. Now, why 2 years? Why are we looking at 2 years and not longer? Well, from what the data is showing us and from what the Bank of Canada and other economists have been saying, is that if this trend continues, we will be deep into a recession within the next 12 to 18 months or so. And so the assumption with 2 years here is that within this time frame, we see rates start to come back down in order to help stimulate the economy. So what we're trying to do is bridge the gap here for about 2 years. That's the thought process. Now, taking into account the fees, is this really the best option at your disposal? Could you find another way? Now, of course, the switch to the new lender and the new mortgage means another commission to the broker. And I'm not saying that this is the underlying motivation for making this suggestion on behalf of the broker. but it should definitely be considered as part of your analysis, in my opinion. Now, look, it's really crazy out there, and it's important for you to have someone in your corner that is going to be transparent with you. That's all I'm saying.